So let's talk about something that's on a lot of UK savers' minds: fixed rate bonds. Are they actually tax-free? It's a huge question. Today, we're going to get you the answer, all thanks to this brilliant guide put together by the experts over at ProTax Accountant. They've laid it all out for us, so let's jump right in.
Here's what we've got lined up. We'll start with what a bond actually is, then we'll get straight to that big tax question. After that, we'll unpack your personal savings allowance, look at some really smart tax-saving strategies, crunch the numbers with an example, and then wrap up with what you should do next.
Okay, picture this. You've done the hard work, you've shopped around, and you've locked in a fantastic fixed interest rate on your savings. You're feeling pretty good about it, right? But then, that little voice in your head starts whispering, is the tax man about to come and spoil the party? Let's find out. Right, first things first. Before we can even start talking about tax, we need to be crystal clear on what we're dealing with. So, what exactly is a fixed-rate bond when you get down to it?
Well, in simple terms, a fixed-rate bond is a deal you make with a bank. You agree to lock a lump sum of your money away for a fixed amount of time. Could be 1 year, could be 5. And in return, they give you a guaranteed interest rate that is not going to change. It's all about one thing: predictability.
So what's the appeal? Well, the big pro is that certainty. You know exactly what you're going to get back, and the rates are often way better than you'd find in an account you can dip into whenever you want. The flip side, your cash is locked up. If interest rates suddenly shoot up everywhere else, you're stuck with your rate. And if you absolutely need your money back early, yep, there's usually a penalty.
Which brings us right back to that big $64,000, or should I say, pound question. You've played by the rules, you've earned your interest, but do you actually get to keep all of it?
All right, no more suspense. Let's get this cleared up once and for all. It's time for the straight, no-nonsense answer that you came here for.
And here it is. In the UK, the interest you earn from a standard fixed-rate bond is taxable. It is not automatically tax-free. But wait, that is not the whole story. Not by a long shot. Because just because it's taxable, that doesn't mean you will actually end up paying any tax. And this is where it gets really interesting.
So the real key to this whole thing, the piece of the puzzle that changes everything, is something called the Personal Savings Allowance. You can call it the PSA. Think of it as your secret weapon for earning tax-free interest.
The best way to think about the PSA is like a personal tax-free bucket for your savings interest. Every single tax year, you get to fill this bucket with interest from your accounts, including your fixed-rate bond, and you won't owe a single penny to HMRC on it. The catch? The size of your bucket depends on how much you earn.
Now, this table shows you exactly how it works for the 2025 to 2026 tax year, and this is crucial. If you're a basic rate taxpayer, so you're earning up to £50,270, you get a generous £1,000 allowance. If you're a higher rate taxpayer, that allowance gets cut in half to £500, and if you're an additional rate taxpayer earning over £125,140, I'm afraid your allowance is zero.
Let's just focus on that top number for a moment, £1,000. For the vast majority of savers in the UK, this is your magic number. You can earn up to £1,000 in interest across all your savings accounts each year before tax even becomes part of the conversation.
But what if you're on track to earn more interest than your allowance? Or what if you just want to be as tax efficient as you possibly can be? Well, that's when we need to get a bit more strategic. And honestly, stay with me here. The next point might surprise you and could save you a serious amount of money.
Let's look at the classic head-to-head, a regular fixed-rate bond versus a cash ISA. We know bond interest is taxable, but your PSA can act as a shield. A cash ISA, on the other hand, is a whole different ballgame. The interest is always 100% tax-free. No ifs, no buts. It doesn't use up a single penny of your PSA. And for the 2025-26 tax year, you can put up to £20,000 into ISAs.
So here it is, a pro tip right from the experts on how to play this smart. For maximum tax efficiency, the game plan is simple. Step 1, fill up your £20,000 ISA allowance. That's for your guaranteed tax-free savings. Then, for any extra savings, use accounts like fixed-rate bonds and let your personal savings allowance shield the interest. It's a powerful 1-2 punch for your savings strategy. And that's not all. Here are a couple of other quick tips. Did you know that if you're in a couple, you could use a joint account to potentially double your household's tax-free interest allowance? That's £2,000 for basic rate taxpayers. Also, it's good to know that with government-backed NS&I bonds, while the interest is still taxable, your initial investment, your capital, is 100% protected by the Treasury. That's peace of mind you can't really put a price on.
Okay, theory is all well and good, but I find it always helps to see how this works in the real world. So let's run through a quick case study to see how these rules actually play out with real pounds and pence.
So, this is Sarah. She's a freelance graphic designer living in London, earning a solid £45,000 a year. That income makes her a basic grade taxpayer. She's been saving hard and has a nice lump sum she wants to put to work. Sarah finds a one-year bond paying a pretty decent 5.25%, and she puts her £20,000 in. A year later, she's earned £1,050 in interest. Now, because she's a basic rate taxpayer, her personal savings allowance is £1,000, so that covers almost all of it. Only the extra 50 quid is taxable. Her tax rate is 20%, so her total tax bill is just £10. Pretty good, right?
But hang on, let's throw a spanner in the works. What if Sarah has an absolutely brilliant year with her design business, and her income jumps up to £60,000? That pushes her into the higher rate tax band. How does that change things for her savings?
Well, just look at the difference. The investment is the same, the interest earned is the same, £1,050, but now two massive things have changed. First, her personal savings allowance gets chopped in half, down to just £500. That leaves £550 of her interest taxable. Second, her tax rate on that interest doubles to 40%. Suddenly, her tax bill skyrockets from a tenner all the way to £220. And that right there is why understanding your tax band is so incredibly important.
Phew, okay. We have covered a lot of ground. We've seen that while bond interest is taxable, there are some really powerful tools and clever strategies you can use to manage and often completely wipe out the tax you have to pay. So let's pull this all together.
If you only take away 4 things today, make it these. Number 1, interest from fixed-rate bonds is taxable. It's not automatically tax-free. 2, your personal savings allowance is your absolute best friend for earning interest without paying tax. 3, for guaranteed tax-free growth, always think ISAs first. And 4, as we saw with Sarah, your tax band can make a huge difference to how much you get to keep.
Now, it's really important for me to say this. The information we've gone through in this guide is for general purposes. Everyone's financial situation is different and unique, so you shouldn't rely on this alone to make big decisions.
And for that very reason, before you make any decisions, you really must consult the tax experts. For advice that's tailored specifically to you, get in touch with the team at Pro Tax Accountant. You can reach them on WhatsApp or by phone on 07985 689912, or you can drop them an email at info@protaxaccountant.co.uk. If you want to dive even deeper into this topic, you can read their full guide on their blog. And for more helpful explainers just like this one, make sure you hit that subscribe button on their YouTube channel. Thanks so much for joining me.